Every decade or so, the markets rediscover one of the oldest money machines in global finance, the carry trade. It's seductive in its simplicity: borrow cheap, invest high, and pocket the difference. And right now, as interest rates diverge across the world once again, the carry trade is roaring back to life. But this time, the stakes are higher, the players are bigger, and the risks are lurking where few are looking. So what exactly is the carry trade, and why is it suddenly making a comeback? At its core, the carry trade is the art of exploiting interest rate differentials between currencies. Imagine borrowing in a country with ultra-low rates, say Japan, where money costs next to nothing, and investing that borrowed cash in a country offering juicy yields, like Mexico, Brazil, or New Zealand. You earn the spread between the two rates, known as the carry. If exchange rates stay stable, you make money. If the high-yield currency appreciates, you make even more. Simple enough until the tide turns. For years, the carry trade was the quiet heartbeat of global liquidity. From Tokyo to London, from New York to Sao Paulo, traders would borrow in yen, Swiss francs, or euros and chase returns wherever central banks were hiking. It funded stock booms, corporate bonds, and emerging market debt. It was leverage disguised as sophistication. Then came the crashes. 1998, the yen carry trade implodes as Asia unravels. 2008, the global dollar shortage crushes leverage bets. 2020, the pandemic resets yield expectations to zero. Every time, the pattern repeats. Easy profits on the way up, brutal unwinds on the way down. So why now? Why are investors dusting off the playbook again? Because the world's interest rate map has fractured. Japan still runs negative or near zero rates. Switzerland remains ultraless. But across the US, UK, Australia, and Latin America, yields are sky high. That divergence has reopened the door to the classic funding trades: short the low yielders, long the high yielders. This year, the yen has become the funding currency of choice once more. The Bank of Japan is holding the line on easy money, even as inflation creeps in. Meanwhile, emerging markets from Brazil to Mexico offer double-digit nominal returns and some of the highest real yields on earth. That's irresistible to global capital. Hedge funds, asset managers, and even retail platforms are piling back in. You can see it in the data: yen short positions near record highs, and the Mexican peso, Brazilian real, and even the New Zealand dollar climbing relentlessly. The logic is textbook. As long as volatility stays low and the rate gap remains wide, the carry trade pays like clockwork. But the danger is just as timeless. Carry trades are built on borrowed confidence. They make money slowly, then lose it all at once. Because when markets turn risk off, when something breaks, when liquidity dries up, when central banks surprise, the flows reverse violently. The high-yield currencies get dumped, and the funding currencies like the yen or franc surge as traders unwind positions. It's not just a trade anymore. It's a stampede through a single, narrow door. Right now, the world's traders are betting that calm will last, that inflation is cooling, that the Fed is done hiking, that global growth will hold just enough to keep risk appetite alive. But beneath that calm is a tension only the carry trade can build. Every profitable day is another turn of the spring. Let's break it down further. The math of the carry trade is built on three forces: yield, volatility, and currency movement. The first, yield, is what you earn daily from the interest rate gap. The second, volatility, is what kills you when exchange rates swing. The third, currency drift, determines whether you get a tailwind or a headwind. When volatility is low and spreads are wide, carry thrives. When volatility spikes, carry dies. That's why traders monitor the VIX, bond spreads, and option implied vols like hawks. Calm markets feed the machine. Chaos kills it. The carry trade also drives a quiet geopolitical rhythm. It shapes flows between continents. When global carry expands, emerging markets get capital inflows, currencies strengthen, credit booms. When carry unwinds, that same money vanishes overnight. Currencies collapse and crises begin. The Asian crisis, the Turkish lira collapse, the taper tantrum, all had carry's fingerprints on them. But here's what makes the 2020s version different. Artificial intelligence, algorithmic execution, and institutional leverage have made the carry trade faster, larger, and harder to unwind. Bots don't panic, they liquidate instantly. Risk models pull the plug automatically. That means when the unwind starts, it happens in milliseconds, not days. And central banks are more entangled than ever. The Federal Reserve's tightening cycle pushed the dollar to multi-decade highs, crushing importers and emerging markets. The Bank of Japan's refusal to follow suit created the perfect funding storm. Every time the yen weakens, Japanese investors buy more foreign bonds, deepening the loop. It's carry on steroids. But there's one more layer: political risk. Elections, wars, trade conflicts, these used to be background noise. Now they're catalysts. A sudden sanction, a central bank shift, or an unexpected default can vaporize months of carry gains in an hour. So what's the smart move for traders and investors watching this comeback? First, respect the carry. It's not free money. It's leverage wearing a tie. Second, know your funding risk. If you're borrowing in yen or francs, remember that what you owe can surge when the market panics. Third, hedge volatility. Carry thrives on stability, so buy insurance when it's cheap. It will feel like wasted money until the day it saves you. Fourth, watch the Bank of Japan. As long as it stays dovish, the trade breathes. The moment it blinks, the unwind begins. Finally, remember that the carry trade tells a bigger story about the world. It's not just a currency strategy. It's a barometer of global confidence. When carry is alive, markets are complacent, liquidity is abundant, and risk feels manageable. When it dies, it's because trust has vanished. The carry trade is back because central banks diverged, volatility vanished, and yield differentials widened. But history says it never ends quietly. So the next time you see headlines about record yen shorts or booming EM inflows, remember, the carry trade isn't a trend. It's a warning. Like, comment, and subscribe if you want to understand the deeper currents behind global markets, the forces that drive money before it drives you. The link in the description and pinned comment has our free global macro guide explaining exactly how to read interest rate differentials, volatility signals, and funding flows. Don't just watch the markets, understand them.